Welcome to Volume 5, Issue 25 of the Milestone Investing Newsletter. This week's ex-dividend date is the 20th of June, 2019. Let's jump straight in to look at the FTSE 100 from last week. This is the FTSE 100 showing daily candlesticks. And we can see that last week, the week before, 2 weeks ago, we were in a rising channel. And then last week, we basically went into this declining channel, and you can see that the wicks are getting lower, and so it's kind of falling. And then today, Monday, it kind of just started to hug the outer the ceiling, just go above the ceiling. So it could actually change its direction, because obviously it was in the middle of the channel and now it's kind of wanting to come out on the upside. So, and this was last Thursday as we were looking at it. So this Thursday, this Friday, weekend, and then today, Monday. So we've had a kind of a, pretty flat market, but it was more or less down. And if we look at the volume, it's massive, massive volume. So that means we have a lot of volume, and it's, buyers and sellers, but it's more or less balanced because it's not going anywhere. But ultimately, it looks like we're kind of beginning to come out of this side downward channel. And you might even argue that this is really just going sideways, because if you look at the body of the candlesticks, we're going sideways. So even though you could argue that it's downwards, you could also argue we're in a sideways channel. So that's what happened last week. What about the 15-minute perspective? This is Wednesday. Wednesday, the market was heading south, and then it bounced when the FTSE 100 opened. Sorry, when the Wall Street market opened, when America opened, and it bounced back up again. On Thursday, we were heading for the stars, and then it peaked in the morning around 10 o'clock, and then it started to come down again. And that's Wednesday. On Thursday, and this is between 8 o'clock and 4:30. Then on Thursday, then on Friday, we get a downward move sideways up, fall back down again, and then it starts to rise up in the afternoon. And that's where we leave it as of last week. And then this week, Monday, the 17th of June, we were very in choppy waters, going sideways, and then it basically headed south. Exits the Bollinger. It goes into the zone where it's too cheap, below 30 on the RSI, and then it basically bounces up, goes sideways a bit, and then starts racing upwards in the afternoon. So this is basically the look of the FTSE this week. If we just draw a straight line going from here, just where we are, 630, we're in this range, we're above that range, we're in that range, we're below the range, and we're in the middle of the range. So in this range, we're basically where we are now is where we were on Wednesday. Then we're above that on Thursday, we're below that on Friday, and we're below that on Monday, and we end with it today. So technically, if you compare it to this, if we count this as the midpoint, really we ain't going anywhere. Below it, above it, below it, below it, back to this midpoint range. So you could argue that we're kind of going sideways. Okay? You could argue that. All right, let's jump straight in and have a look at what was going on for the companies last week that were paying dividends. And the first candidate is Persimmon. Let's look at Persimmon. Persimmon was inside the range between the green line and the red line on the Wednesday. It then goes ex-dividend, the share price drops, and it drops to the break-even point at the closing price. And then it goes slightly above, slightly up, and then sideways. It continues in that range back to the break-even point at the closing price for those who went short, by the way, and then it continues to go sideways. It goes up a little bit, hits top of the Bollinger, it comes back down to the bottom of the same Bollinger, and then moves sideways. What this is doing, this is using the dividend adjustment as support. It's using the dividend adjustment at the closing price as support. And this is where we are for Persimmon. For shareholders who went short, they made anywhere between -5% and 9% for professionals, and non-professionals -2 to 4%. And if you went long, you clearly haven't gotten your original capital back yet, but if you were a derivative trader as a professional, you received 106.8% dividend or 26.7% dividend. But as we can see, you're not going to get your money back anytime soon, as indicated by this dead dog flat movement. That's Persimmon. So let me explain what dead dog is, by the way, because I've just given you a phrase there. When they say cats have 9 lives, so if a cat falls out of a window, more or less it bounces back up again. So if you had a dead cat, it would fall and bounce back up, and go back up. A dead dog falls out the window and just stays there. It stays flat on the ground. It doesn't go anywhere. He's injured. This is a dead dog pattern. Let's go to WPP. WPP on Wednesday, highest point was a green line, lowest point was a red line. What does it do? It goes ex-dividend and it gaps down, and it gaps down to the dividend adjustments like before, the dividend adjustment at the closing price. So we've got dividend adjustment closing price, we've got the dividend adjusting at the lowest price right here. We've got the mile scope adjustment based on the closing price, and we've got the mile scope adjustment placed on the lowest price. What does it do? It goes sideways, moving along the dividend adjustment line. It then goes to the dividend adjustment at the closing price. And then it goes back up to the, sorry, it goes to dividend adjustment at the lowest price. It then goes back up to dividend adjustment at the closing price. And that was the movement for Thursday and for Friday. It's going sideways. And then Monday, it starts to make its way up. By about 10 o'clock, it basically peaks and then starts to move sideways. So we've got some upside strength, and it looks like in a few days, you might want to head for the green line, meaning that it will give back to long traders their money back with a dividend. But let's talk through the numbers. As of the weekend, obviously we publish the newsletter on the weekend. So as of the weekend, this delivered for short traders, for professionals, anywhere between 3 and 14%. For professionals and non-professionals, between 1 and 5%. And what do I mean by that? I mean those who went short on Wednesday, they paid a dividend, and the difference between the dividend payment at the break-even line here and the excess, extra, this is their gain. Professionals, once again, between 3 and 14%. Non-professionals between 1 and 5%. That's what they made at this point here. If they went long, professionals picked up a dividend of 74.2% on the derivative, and non-professionals picked up an 18.6% dividend based on the derivative. And we can see that the share price is looking like it wants to go back up and give them back their original capital. But not yet. It needs to go into this range and certainly above the green line to give everyone back their money. The next one, Severn Trent. Severn Trent was trading between the green line and the red line on Wednesday. It goes ex-dividend and it gaps down. And it hits the dividend adjustment line at the break-even point and uses that as support and bounces right back up again. It hits the lowest point of Wednesday and treats that as resistance, and it falls back down. It then goes back up to the same closing price, so the lowest price on the Wednesday, and uses that, hugs it as a ceiling. It comes back down again, and it goes sideways just below that on Friday. And then Monday, it goes into positive territory for those who got the lowest price or the first 15 minutes lowest price on Wednesday. Then it goes back into below the red line. And then it starts to kind of use that almost like a ceiling. So it's not quite ready yet to break through. Now, historically, this one does not rise very quickly. So this one rising up so quickly is a surprise, and it's going against the trend of its historical performance, but that is 7 trend. On the short side, the return on investment was for professionals was anywhere between negative 11% and positive 7% for professionals, and non-professionals between negative 4% and positive 2%. Had you gone long, you would have picked up a dividend for professionals equivalent to 53.8%, and for non-professionals equivalent to 13.4%, 7 trend. The next one, 3i Group. 3i Group is trading on Wednesday between the green and the red line in this kind of a narrow range here. It goes ex-dividend, the share price drops. So what we have here, it gaps down and then basically starts to make its way up. It hits the moving average on the Bollinger, treats that as resistance, and starts to go back down again. In the late morning on Thursday, it keeps on falling, hugging the outer band of the Bollinger, and it goes below exit point, meaning short traders make their money. It then hovers quite low into very large profits for short traders, and then it makes its way back up again. And then as of Monday, it's hugging the exit point for short traders. Short traders, for professionals, they make anywhere between 34 and 47% for professionals, or between 11 and 15% for non-professionals, short traders. Long traders, professionals picked up a dividend equivalent to 37.3% on the derivative, or 9.3% for non-professionals. And again, no sign yet that it's going to go back up to the pre-ex-dividend share price high and give them all back their money on the long side. No evidence yet. The last one from last week. NMC Health. It trades between the green line and the red line. So you can see majority of the volatility took place in the first 15 minutes. And then after that, it's basically, bobbing around in the bottom half of the trading range for Wednesday. On Thursday, it gaps down. It races right back up again straight away. So in the first 15 minutes, everybody apart from the first candlestick who got in on Wednesday long got their money back. That was the first opportunity. It gaps down and it falls back immediately, and then it starts to climb slowly. And by about 9:30, everybody who went long had the opportunity to get their money back right here, because it goes above the green line. And then it starts to trickle down, and then hits the bottom of the midpoint, the moving average on the Bollinger, and then the market closes on Thursday. On Friday, it gaps down, and then it starts to head for lower. It starts marching downhill. It clearly goes past the exit points, the break even, adjustment line. So it goes past the dividend adjustment line and the Marscope adjustment line for on the short side, and then it basically hits the Bollinger, bounces back up, goes back to the bottom of the Bollinger, and then starts to head upwards. That's Friday. And then Monday, heads back up again, back down, up again, and back down, and goes back to the range where the dividend adjustment is said to be providing resistance. And why is it resistance? Because it's coming from underneath it. If it was sitting on top of it, that would be support. It's kind of going underneath it. So we'll see what happens there. What's the return on investment? Well, for short traders, professionals, they got anywhere between and this is for Thursday, Friday. Newsletter again is published on the on the weekend, so that's what we have data for. Anywhere between 14 and 35% is the return on investment for professional short traders, and for non-professional short traders on NMC Health, they got anywhere between 9 and 18%. For long traders, and that assuming that you went long on Wednesday and picked up your money on Thursday. Now, clearly you had this massive move up, which clearly must mean you must have hedged it, or you had nerves of steel. But essentially, this one starts to go long massively by the morning, and those who stayed for the ride, well, they picked up a dividend. If they went long, they got a dividend of 7.6%, and they got their money back right here. Long, so professionals got 7.6%, and non-professionals got 3.8%. And that is the picture for last week. Okay, let's look at this week. What's happening here? We have 3 companies paying dividends: United Utilities, Land Securities, Compass Group. United Utilities is 81 in the FTSE 100, Land Securities 68 in the FTSE 100, and the Compass Group is number 17 in the FTSE 100. They are paying between them nearly £500 million. In terms of return on investment, what can we expect? United Utilities is paying a 3.3% dividend if you buy the shares, and a 66.8% derivative yield if you pick up the derivative to qualify for the dividend. And that's for professionals. Non-professionals, United Utilities is 16.7. Land Securities is 1.4% dividend yield if you buy the share. If you get the derivative, professionals get 27.7%, non-professionals get 6.9%. And Compass Group is paying dividends of 0.7% if you buy the share. If you buy the derivative, you are going to get, professionals will get 13.7% and non-professionals will get 3.4%. Let's look at United Utilities. United Utilities Group PLC is a water company. The company through its subsidiary United Utilities Water Limited, United Utilities Water, manages the regulated water and wastewater network in the northwest of England, providing services to around 7 million people and businesses. It owns over 55,000 hectares of land around its reservoirs. It collects water from the environment, clean and distributes it to its customers before collecting it, treating it, and then returning it back to the environment. The company produced approximately 138 gigawatt hours of renewable energy through sludge treatment centers and solar installations, enough to power over 40,000 homes. It delivers approximately 1.7 billion liters of clean drinking water to its customers every day through over 40,000 kilometers of water pipes. United Utilities Water holds licenses to provide water and wastewater services to a population of approximately 7 million people in the northwest of England. Stephen Mogford is a CEO and John Holden is a CFO. They pay dividends twice a year and they're number 81 in the FTSE 100 with a valuation of 5.4 billion. Had you traded this company for its dividends in the last 7 years, you would have had 15 opportunities to trade this company for its dividends. Had you gone long 4 times out of 15, 27% of the time, you would have gotten your money back within a week. 7 times out of 15, 47% of the time, you'd have taken more than a week, but less than a month to get your original capital back, had you gone long. And 3 times out of 15, 20% of the time, it would have taken you more than a month to get your money back. And within a 7-year period, there was one time, 725 days ago, when you would not have gotten your money back as yet. So someone asked me some time ago, what does it mean by not getting your money back? What it means is that the share price is below the price you entered at. So if you sold at a price lower than where you enter, then you're going to make a loss. If you don't sell the share price, then obviously you don't make a loss. But if you sell it now, you'll be making a loss. So that's what that basically means. You haven't got your money back yet. What about those who went short? Well, because we know the share price drops first and goes up second, we only count the first 2 days, Thursday, Friday. So day 1, Thursday, 7 times out of 15, you would have made money, which is 47% of the time. And your return on investment during that time was anywhere between 4% and 21%. And on day 2, 9 times out of 15, 60% of the time, you made money going short on day 2. Return on investment was anywhere between 1% and 54%. United Utilities. Let's look at their fundamentals. In 2015, March 2015, they had a turnover of 1.7 billion. 2016, 1.7 billion. 2017, 1.7 billion. 2018, 1.7 billion. And 2019, 1.8 billion. So we've got some, relatively flat turnover, which goes up a little bit in 2019. So we've got some stable income here. Profits, 342 million, up to 354 million, up to 442 million, down to 432 million, back up to 436 million. So we've got a climbing profit. It then drops and then kind of plateaus. If we look at the profit margin, we can see that for every £100 made, £19.90 dropped to profit. For every £100 made in 2016, £20.40 dropped to profit. For every £100 made in 2017, £26 dropped to profit, rising. And then it drops back down again. $24.90 dropped to profit from every £100 of sales or revenues. And then that's 24.9 and 24 dropped to profit from 2019 revenues. And this one is higher than this one, even though the profit margin is down, because the revenue is a much, much higher figure. The lack of cost control, which is basically what this amounts to, is not sufficient, it's not high enough to make it a number smaller than this, okay? But we can see that their profits is down as a percentage of revenue, okay? And this has come back down to cost control. So they are promising to pay £188 million. They have profits of 363 and cash of 339 as of March, 3 months ago. So essentially, this is something that is affordable for them. They have a valuation, as we said earlier, of 5.4 billion, and they've got a net book value of 3.1 billion. And this means that they are trading at 1.7 times book value. 1.7 times book value. United Utilities. Let's look at their 5-year, well, let's look at 5-year trend. So we can see they kind of peaked in 2017, and then they tried to fall at the end of 2017. And then at the beginning of 2018, they started to basically move up gradually. And now they're going sideways for 2019. That's United Utilities. Land Securities Group. Land Securities Group PLC is a UK-based holding company. The company is a real estate investment trust. The company operates through 2 segments, retail portfolio and the London portfolio. The company's retail portfolio includes all the shopping centres and shops, excluding London shops, so central London shops, hotels and leisure assets, and retail warehouse properties. The company's retail portfolio has a floor space of approximately 17.45 million square feet, which includes over 10 shopping centres, approximately 10 retail parks, over 8 standalone leisure assets, and approximately 30 Accor group hotels in the United Kingdom. The company's London portfolio includes all the London offices and central London shops. Its London portfolio has a total floor space of approximately 6.16 million square feet, which includes West End offices, City offices, Midtown offices, inner London offices, and central London shops, amongst other things. Robert Knoll is the CEO. Martin Greenslade is the CFO. They pay dividends 4 times a year, and they have a valuation of 6.2 billion, and they are number 68 in the FTSE 100. Had you traded this company for its dividends in the last 7 years, you would have had 31 opportunities to trade this company. 15 times out of 31, 48% of the time, you would have, had you gone long, you would have gotten your initial investment capital back within a week. 9 times out of 31, 29% of the time, it would have taken you more than a week but less than a month to get your initial investment capital back. Your initial investment capital back. 4 times out of 31, which is 13% of the time, it would have taken you more than a month to get your money back. And 3 times in the last 7 years, you would not have gotten your money back at all. The 3 times, 1,290 days, 723 days, and 359 days have elapsed since that time. 7 times out of 31, 55% of the time, had you gone short on day 1, you would have made money. Anywhere between 1% and 45% return on investment. On day 2, 13 times out of 31, that's 42% of the time, you would have made money going short on day 2. Your return on investment would have been anywhere between 3% and 49%. Between 3% and 67% on day 2. Let's look at their fundamentals. This is a real estate company. So we've got revenue, 770 million, 942 up, down, 787 up, 830 down, 757. Their revenue is all over the place. It's bouncing down, up, down, up, down. The profit, 2.4 billion, 1.3 billion, it falls. 112,000, 112 million. And then it goes in 2018 into negative, 43 million pounds loss. And then it falls again to 123 million pound loss. So this is basically going downhill. It went from profits and it's now sporting some losses. If we look, if I don't like to look at the profit margin with real estate type companies, because of the accounting anomaly, you can actually end up having profits higher than the revenue streams. And so for that reason, I don't really look at these numbers. So I'm going to leave that alone. Land Securities, they want to pay a dividend equivalent to 86 million. They have a loss of 119 and they've got cash of 14. So that doesn't even make sense. Why would they offer to do that? And clearly the reason why they're doing that is because they want shareholders to hold on to their shares and they're rewarding them for their loyalty. So this means because they haven't got the physical cash, they're going to have to sell assets to get that cash, work on, accumulate revenue streams, that have been accumulated since this date, since March, and that's in terms of cash flow, or they're going to have to borrow the money. However they do it, they're going to be their challenge. They have a valuation, as we stated earlier, of 6.2 billion, and they got a net book value of 9.9 billion. Again, real estate is, is pretty expensive. And so what we have is they're trading at 60% of their book value. So you could technically argue that they're actually trading at a discount. Now, this is the kind of numbers that Warren Buffett would have been paying attention to. And when a company is trading a discount on their book value, he would look into this in more details. But this is what these guys are doing. Okay. Let's go to their 5-year trend in terms of share price. These candlesticks are 1 month. They're showing 1 month. And what are we looking at here? Where we can see that it peaked in 2015, the last quarter of 2015, it peaked, and then it started to fall. And then really it kind of was moving sideways up until the midpoint of 2017. And then really became just gradually falling up until end of last year. This year, it was moving back up again. So for the first 4 months, it was moving up. It hit the midpoint of the Bollinger, treated that as resistance, fell back last month, and bouncing back up again. So that Securities is kind of just wanting to stay in this range. Now, those losses that we saw earlier is obviously having a downward drag on this particular company. So, people might not be overly optimistic as to what's going on with these guys. Let's look at the last one for this week. Compass Group. Compass Group PLC provides food and support services. The company segments include North America, Europe, rest of the world, and central activities. The Europe segment includes Turkey and Russia. The rest of the world segment includes Japan. The company delivers services in sectors including business and industry, healthcare and seniors, education, defense, offshore and remote, and sports and leisure. The company offers its services to customers in the workplace, schools and colleges, hospitals, at leisure and in remote environments. It provides breakfast, lunches and dinners, and also offers hospitality services. The company offers a range of support services, including cleaning, building operations and maintenance, business and office services, logistics and transport, outdoor project management and security. Its food service offerings under healthcare and senior sector include patient feeding, retail food courts, hospitality, catering, vending, retail shops, and staff restaurants. Dominic Blakemore is a CEO, and then we've got an interim CFO and a CFO. Palmer Brown, the interim, and Karen Witz, the CFO. They pay dividends 2 times a year. They are number 17. They're in position 17 in the FTSE 100 with a valuation of £28.3 billion as of June 2019. Had you traded this company for its dividends in the last 8 years, you would have had 19 opportunities. Now, 2 times 8 is 16. So how are you getting 19? Because they're paying special dividends. So 3 times would have paid special dividends in that period of time. 11 times out of 19, 58% of the time, had you gone long, you would have gotten your money back within 1 week after qualifying for the dividend. 6 times out of 19, which is 32% of the time, it would have taken you more than a week and less than a month to get your money back. And 2 times out of 19, 10% of the time, it would have taken you more than 30 days to get your money back had you traded this particular stock. What about going short? 9 times out of 19 on day 1, which is 47% of the time, you would have made money going short. Your return on investment would have been anywhere between 1% and 24%. And on day 2, 8 times out of 19, 42% of the time, you would have made money on this. ROI would have been anywhere between 1 and 40%. Fundamentals. 17 billion, 18 billion, 2015, 20 billion, rounding, 2016, 23 billion, and 23 billion, 2018. So we've got a nice upward progression. Profits, 1.2, 1.2, up again to 1.4, up again to 1.6, and up again to 1.6. We've got an upward progression in the profits. If we look at their profit margins, we can see that these guys are consistently delivering 7% return on investment, anywhere between 6.9 and 7.2, but 7% is their number. Okay, they're being consistent, they're managing their costs, and you can see that they've got their finger on the pulse of this particular business. Okay, management are doing, financial management and management are doing their job. These guys want to pay a dividend. They want to pay a dividend of 208 million. They have profits of 1.3 billion and cash of 900. Very doable. They have a valuation of 28.3 billion and they have a book value of 2.6 billion. So these guys are trading at 11 times book value. If we look at their P ratio, it's 24. And it ranges from between 20 and 25. So it's kind of in a pretty stable place. Compass Group, what is their 5-year trend? These guys are in an upward cycle. So what does this mean for this particular company? If a company is trending up and continues to trend up, if you just bought them and held them, you're going to increase your capital. So let's look here. At the beginning of this one, say 10 years ago, I believe, the share price was roughly just under 1,000. It's now 1,911. So let's call that 900 or just under 1,000. So we're talking about basically a 90% increase in the share price in the last 9 years. 90% in 9 years, that's 10% a year. These guys are not only are they giving you dividends, but they're giving you 10% capital growth on your money. Compass Group. Okay, so let's summarize what we just said. We can see that United Utilities has historically the best track record of rewarding short traders, and Compass Group historically has the best track record of rewarding long traders. Long traders. And if we look at this in more detail, we can see that, I was going to go to recent history. So basically, Land Securities on the right, we can see that, in fact, let's go back to what we said. We said United Utilities got the best track record for rewarding short traders. Okay, well, that is true, but the very last time, i.e. last 6 months, they recovered very quickly. So these guys have the potential to recover quickly. You don't want to be going short with our companies rising very quickly. That's kind of problematic. You're going to get caught on the wrong side of that particular move. But apart from this one, you've got 158 days. Then you've got 12 days. And this one hasn't recovered yet, 725 days. Then you've got 13 days to recover, 5 days to recover. Again, another Usain Bolt performance. And then 102 days to recover, 1 day to recover, 14 days to recover. 1, by the way, means Friday, 1 day after Thursday. 0 means Thursday, the ex-dividend date itself. 14 days to recover, 9 days to recover, 47, 28, 8, and 14. So you can see this is the performance, and you can see the recent history. They had a little sprint effort here, but other than that, the last 2-3 years, pretty reasonable. We said that Compass has the best track record of going long, and the very last quarter, it took 19 days to recover, and then you got 0 days, which is basically Thursday, 4 days later, Thursday, 4 days later, 14 days later, 1 day later, 6, 19, 0. So if we go back to the most recent history, last 2 years, we can see that really, with the exception of this little one here, 2 weeks to get your money back, or no, 1 week, you're getting money back for the last 2 years. And then we got 3, by the way, in 2017. That means they're paying special dividends, obviously. And what we have here, 1 week. And then this one is under 3 weeks. That's 2 weeks. And that's the performance for Compass. Land Securities, again, we had a little sprint effort last quarter. But then before that, 62 days to recover, 179 days to recover. This one hasn't recovered yet in over a year. And then we've got another sprint effort here, 0 days, 1 day, 4 days. So this one's a little inconsistent. It can sprint, or I should say, it takes a long time, but it's got a sprint finish. So this is like your Kenyan long distance runners. It takes a long while to recover, but they have got a kick, so they can sprint at the end, okay? This week's economic calendar. 2017, no announcements. 2018, we've got 10-year Treasury gilt auction. 2019, we've got a slew of data coming out. Core inflation, PPI core output, PPI input, inflation rate, PPI output, and retail price index, all at 9:30 on Wednesday. Market might have a position and wobble a little bit based on that. Then on Thursday, another slew of data, retail sales, including and excluding fuel. We've got Bank of England Monetary Policy Committee data coming out in relation to voting, either to change, hike, or cut rates, interest rates. Then we've got the Monetary Policy Committee meetings. Then we've got data on the Bank of England's quantitative easing, interest rate decision, and then we've got a Mark Carney speech at 9 o'clock in the evening. Friday, public sector net borrowing data coming out at 9:30 in the morning. And then we've got the CBI, the Confederation of Business Industries, industrial trends, CBI, industrial trends, CBI industrial trends orders, CBI industrial trends orders for June. And that comes out on Friday. So that's your picture for last week. What about next week? Let's do a crystal ball gazing into the future. We've got 3 companies next week. We've got Burberry, British Land, and Experian, which is at 1.8% dividend yield, 1.4% dividend yield, and 1% dividend yield. And if you go with the derivative, professionals can expect 36%, 28%, and 20% or 21% respectively. Non-professionals, 9, 7.2, 5.2. You may remember a character in the American Army called Colin Powell. He says, there are no secrets to success. It is the result of preparation, hard work, and learning from failure. There are no secrets to success. Success is the result of preparation, hard work, and learning from failure. This is also true for stock market trading success. Prepare yourself for your trades. Work hard on your, just really taking notes and making sure that you're paying attention to your, diarize what you do, and just pay attention to your trades and record what you do and look at it and learn from it and learn from your mistakes, because everyone makes mistakes in trading, but just learn from them. And once you do that, you go back and you really want to just have a strategy, have a plan, test your plan to make sure it's, it's effective. And if once you have something that works, stick to it. There are no secrets to success. Success is the result of preparation, hard work, and learning from failure. This is Miles from Milestone Investing. That is all for this week. Happy investing.